the A-Level Seminar Series organized by the Rotary Club of University of Colombo, Faculty of Management and Finance. Today, to conduct this session with us, we have Mr. Abdul Qadir Muhaid, CFA Charterholder ACCA affiliate, 4+ years of work experience in the fields of investment banking, equity research and advisory, 2+ years of experience in lecturing ACCA UK, local and London O-level and A-level students, lecturer for GCE A-level accounting at EDGE Institute and for the ACCA program. Very warm welcome to you too, sir. And without further ado, let me hand over the meeting controls to him.
Hi, I hope everyone can hear me clearly. First of all, thank you very much for the Rotary Club of the University of Colombo Faculty of Management and Finance for requesting me to do this seminar for the 2021 A-level students. So I think let me start off by sharing my screen. Right. Yeah, so I hope my sound, everything's clear, right? Yeah. Yeah, so I think just to start off, this I'll be doing the lesson today on investment appraisal, and this is a section which comes under the management accounting section towards the end of the grade 13 syllabus, right? And this is an area which is tested every year in the A-level paper. So if you take the past 10 years of papers, it has been tested every year in the paper 1 on the MCQs, or even the last 20 questions in the MCQs, the objective test questions, and in paper 2, right? So this is a very short and easy lesson. It's not so complex. You just need to get the basics right. It's a matter of putting things into certain formulas or formats and calculating, right? So what I'll be doing today is I will run through the TUT, a few pages I have prepared, and once we do that, I will do some questions from the past papers. So I've selected certain questions based on new learnings in each question, right? So there are certain things in each questions to learn. So I've selected those questions and I will do that. So yeah. So to start off, so like you know, every company makes certain decisions, right? And some of these decisions can be long-term and short-term decisions. So when it comes to investment appraisal, we mainly focus on the long-term decision making, right? So I've just given some examples for y'all on the different types of short-term and long-term decisions a company makes, right? So in the short term, maybe the company wants to increase prices of goods, change, you know, maybe increase their stocks or their inventory levels, right? Or maybe they want to reduce the amount of credit period they give to their debtors, to their customers, right? So these are short-term decisions, but a company sometimes may want to build a factory, right? Or you know, open a warehouse, right? Or purchase a very expensive machine. So all of these require a huge capital investment, right? It's not very cheap when you make long-term decisions, and there is so many factors involved, because once you spend that money, you can't recover it back. So whatever the decision you make in the long term, it needs to be carefully evaluated, and that is when investment appraisal comes in. So basically, practically also in the real world, these methods are followed, and these are practically used, right? So if I think if you all have any questions, you all feel free to unmute and let me know. I think you all can even type it on the chat box. That should be fine. Yeah, so characteristics of long-term decisions, right? So what's the main difference between short-term and long-term decisions? So when it comes to long-term decisions, like I said, the scale of investment is very big. So which is why you need to carefully evaluate when taking these decisions. So I know sometimes these might seem very obvious, but some of these can be tested in your paper 1 in the MCQs or in the writing section, right? So that is why some of these points are very important. And again, when taking long-term decisions, there's a huge risk. Why? Because the cost is a significant amount, and once you invest, you can't recover it back. It's not a small loss, right? And some of these informations are communicated to shareholders and stakeholders. So once you, let's say you go back on your decision or you cancel the decision, these could affect the company's long-term view by shareholders, right? Sometimes stock prices can crash if you say you suddenly cancel the project, so stuff like that, right? So it needs to be carefully evaluated. So these decisions are unchangeable, right? Once you go ahead and you get the approval, sometimes it's very hard to reverse with a sudden change of mind. and the funds necessary are throughout long term. So sometimes companies will allocate funds for these long term projects, which may be used over the next 5-6 years, right? So it's not easily, you can't take that funds or that money and put it into another project easily, right? So how does this process work? How do you appraise an investment, right? So what you do first is you identify what are your options for investing, right? And then you check, let's say we are starting a factory. Other than a factory, where can I invest my money? Is it best to put in a factory, or is it best just to put, open a fixed deposit and put some money and earn an interest? Or maybe I should start another company, maybe abroad, another branch. So you identify different options for you, right? And then you estimate the cash flows in each of these options, right? How much will I earn? Your revenues, your costs, any other working capital which you will need from day-to-day expenses. So you estimate all these cash flows for the next for the time period of that investment, right? And then you evaluate them. So how do you do the evaluation? Is basically by carefully. I think as we go on the questions, we will be doing that evaluation portion where we discount these and stuff. So I'll explain more there. And then after that, you select the best project for you and you implement it. Yeah, so I think someone's asking, we didn't get tuned. Actually, so this is something I prepared just to show it on during the class. I hope that's okay. But don't worry, I think there shouldn't be a problem. I can email it to you all after the class. So I'll just send it to someone at the Rotaract. I hope that's fine. Right? Yeah, so there are 4 investment appraisal techniques. The first one is called the accounting rate of return, ARR, payback period, net present value, NPV, which is the most famous one and the most tested one in the exam. And finally, something called the IRR, internal rate of return. You don't have to worry about the last one. That is not tested actually mainly in the exam, local levels. But just for you all to know that there is another method like that, practically used as well. So moving on, so like I said, what I'm going to do is I'm just going to run through, have a brief overview on the TUT. And what we'll do is we'll use this theory which we learn now, this knowledge, and we'll apply it to few questions we'll do from the past papers. Yeah, I hope that's okay. So ARR, so that this is the first method and the easiest method when it comes to investment appraisals. So there is a formula given here, and even in the exam, you will have to use this formula in calculating, right? So how this formula works is, as you can see it's average annual PBIT, means profit before interest and tax, which is also called operating profit. In the exam, if they give you just saying profit and they don't give you any tax information or anything like that, assume that is the profit they're talking about, right? You divide it by the average investment and you multiply by 100 to get a percentage answer, right? So I will explain now what each of these items mean, right? So average annual PBIT means you will, when you're appraising this investment, so in the question, you will be getting your profits for a few years. They will say you're earning 100,000 every year. Or for each year, they will give you a certain profit number, right? And how do you calculate this numerator number is basically, you will, I have broken that equation down here. Basically, you will total your profit during that entire period. Let's say the project's lifetime is 5 years. You will add the profits for all 5 years. And then you will divide it by the number of years. So that is the main important component here. I would say this denominator, because that is where students get confused. Sometimes when you say average, students tend to divide it by 2, right? Which is wrong. When you take average annual profits, it has to be divided by the number of years, right? So students sometimes, on the day of the exam, they're nervous, they're stressful. So sometimes, they make these small mistakes, right? So these are things to be careful of and to watch out. So that is when it comes to the numerator. The denominator also, I have broken it down into another formula. So basically how you calculate average investment is initial investment plus the scrap value divided by 2. Now here, that is where students get confused. So here is where the dividing by 2 is required, not in the calculation of the numerator, right? So there are some questions from the past papers. We'll do it as we go along, right? So once you get this answer, right, once you calculate, let's say your ARR is 20%, right? Companies generally set a target rate in their company, right? Any project above 15%, we will go ahead. So how you make this decision? So what happens in investment appraisal is when you appraise an investment, when you evaluate an investment, you're deciding whether should I invest in it or not. So how do you know whether you should invest in it? Based on the calculations you do, based on that evaluation. So if your ARR is higher than the target rate the company sets, then you are going to accept the project. That is how you make the decision. Like I said, if the company has set a target of 15%, and let's say in your evaluation, you find a project, you evaluate it, and you get a return of 20%. So it's higher than your target rate, so you will go ahead and accept the project. And vice versa, if your ARR is lower than your target rate, you won't accept the project, right? So I've given some examples here. Once I send the tutor, you guys can try it out as well. Right, so I'll just skip that for now, and I will move on to the advantages and disadvantages, because like I said in paper 1, the last 20 questions are objective test questions, and these are theory areas which are tested, right? So sometimes they may tell you to write the advantages and disadvantages of certain methods. Right? So when we take ARR, let's look at the advantages. It's very easy and simple to calculate, right? It's just a formula, so it's not very complex. You apply the information to the formula, and then you get your answer, right? I hope my connection's okay. If you guys can hear me, if there's any issues, please let me know, right? And then this is linked with other accounting measures, right? So what that means is basically when we calculate ARR, you saw in the formula, we use profits. So profits we can easily obtain from our financial statements, right? Or maybe even the expected profit from the project. So that's why it says it is linked with other accounting measures. It's linked to profit, right? And this method of evaluation can be implemented with low cost. It's a formula. I mean, even if you're getting it done by a third party, it's simple. It's not complex working, right? Even if companies use systems or different scenarios, it won't cost much, right? And it's easy to select investments with higher returns. So it automatically tells you an answer. Okay, if it has a higher rate, you can easily select, okay, this is the project I should invest in. But this is one of the very weakest methods in investment appraisal as well. And I've listed out the disadvantages as well, right? Uses profits and not cash flows. Now that is a main disadvantage. Even though it is linked, like I said, it's linked with other accounting measures, it is a disadvantage. Why? Because companies can manipulate profits. And when we say manipulate, it's the good and the bad. Bad in the sense where you do frauds and errors. The good manipulation in the sense is sometimes each company's depreciation policy can differ from company to company, right? So if a company uses a lower depreciation rate, your profits are going to be high, right? So then, but even though depreciation is a non-cash expense, right? So therefore, it might not give the true picture of that project when you use profits and not cash flows. But cash flows are cash which you get to your hand, right? This is like, that is why you do a cash flow statement as well when you prepare company accounts, right? Because then you know how much cash do you get actually in your hand and not the profits. Because companies can sell products, can earn revenues, but they can sell a lot on credit. And when you sell on credit, what happens is you get a lot of trade debtors in your balance sheet. But you might not be able to collect cash for all of them. Some of them might not pay you. So you'll get more bad debts. So that is why cash flows are very important than profits, right? Secondly, you don't consider the timing of the cash flow. So basically when you do ARR, we assume all the profits for the next 5 years or 4 years, right? So we don't think that, okay, the profit you receive in year 5 is not the same as today. You all would have heard of inflation, discounting, time value of money. These all are different concepts to explain that, right? So because you all would have heard this, right? Even when your parents say everything, especially these days with all these products, stuff, goods are very high. They say 1,000 rupees which you can buy something today is not what they bought a few years ago, right? So the timing of the cash flows needs to be considered. And here this method does not do that, right? It assumes the same, let's say if you're supposed to receive 100,000 in 5 years, that 100,000 is equal to as today, which is a big disadvantage. It does not measure the absolute gain. What that means is, now the answer you get in ARR is a percentage, right? It doesn't tell you how much is your actual absolute return in numbers. Is it 50,000? Is it 100,000? It doesn't tell that number. It just tells a percentage, right? So we don't know if that's a good percentage or bad percentage. Even though if it is good, even though if it is above the target rate and we decide to accept the project, it doesn't tell us how much we will actually create value or earn in numbers, right? And it doesn't have a definite investment signal. Let's say, like I said earlier, let's say you get an answer, you evaluate and you get an ARR of 20%. Should you invest or not? You don't know. You need another rate to compare. But on its own, ARR doesn't tell us an investment signal. It doesn't tell us whether should we invest or not. Is 20% a good thing or a bad thing? Right? If your target rate is 15%, it's good. If your target rate is 30%, it's bad. So on its own, it doesn't tell us whether to invest or not. You always need a comparable. Right? So that is what is meant by no definite investment signal. Right? So I hope that's clear. If you guys have any questions, I think you all can just type it in the chat or unmute and speak. I hope that's okay. And I think you guys can ask me as well later, right? So we'll go on to the next method, and once we do these questions, we'll be applying all of these methods onto some questions, and we'll go from there, right? For investment appraisal, I'm just reading through the tube, right? For investment appraisal purposes, it is more appropriate to evaluate cash flows rather than profits. So this is the explanation I gave earlier. Why? Because profits are subjective. You can manipulate them. But cash is required to pay dividends. If you get cash only, you can pay dividends to your shareholders. So therefore, we consider something called relevant cash flows when it comes to investment appraisal. Because of the weaknesses in ARR, we consider cash flows. That's the first step. And when it comes to cash flows, we consider something called relevant cash flows, right? So I'm going to bold that word so that it's more clear. So what do you mean by a relevant cash flow, right? A relevant cash flow is basically, it has a few characteristics. And first one is futuristic. That means this cash should occur in future, right? It can't be something which you incurred before you start the project, right? The second one is incremental. That means the cash flow should occur as a result of you implementing this project, right? You can't consider another project's revenues into this project, right? And you will, of course, include, it has to be cash based, right? Or it's also called opportunity cost. That means in your investment appraisal, you need to include any opportunity costs. That means now, let's say you have allocated certain funds to invest in a project. If I'm, let's say you have allocated and kept it. So, but what you could have done is you could have put it into a bank and earn some interest. Now you're not earning that interest. Why? Because you have kept it separately for this project. So that is an opportunity cost, that money or income you're not earning. So that needs to be considered as well, right? So all of these considers come under relevant cash flow. You will need to ignore non-cash items like sunk costs, committed costs, and allocated costs, right? So examples you would have seen sometimes, example like in the question, they will say the company did a market research, right? Now, this was done before you implement the project, and maybe based on the market research, they decided not to go ahead with the project. Now, that cost has already been incurred. You can't recover that in any form, right? So that is called a sunk cost, where you have already spent on it, you can't recover it, right? And committed costs and allocated costs means, maybe you have already agreed to pay a rent for that, for occupying a certain space, and, it's non-refundable, things like that. So all of those you cannot consider in your investment appraisal. So examples are like market research. Sometimes they include costs incurred in developing a prototype. A prototype means like a sample product. So you might incur some costs before you implement the project. So all of these are cash flows you cannot consider. Right? So cash flows are divided into three categories, right? So one is the initial investment, probably in year zero, most of it. Then the second one is operating cash flows. That means during the lifetime of the project. And finally, third one, the terminal cash flow, which means at the end of the project, what are the cash flows? So this is how they have divided all the cash flows of a project, right? So when you're doing investment appraisal, there are certain factors you need to consider or be careful of, right? So we will always use after-tax cash flows when we are doing our investment appraisal, right? Because when you implement that project, you'll be earning revenues, you will have certain costs, and if you have a profit, you will have to pay a tax on that, right? So you're going to deduct that tax and consider cash flows after that, right? And you will, of course, consider incremental cash flows. That means cash flows which will be generated as a result of implementing this project, right? Some costs are not considered, which we discussed a little while ago. Interest is not included. in the exam, if they say the company is borrowing a loan or taking out a loan for this project and the interest rate is 10% or something like that, do not include the finance cost in the under a certain cash. Do not deduct the finance cost. Why is that? Is because the interest rate, the rate you pay, right? Maybe let's say you're taking out a loan and paying interest at 10%. That 10% is already included in your discounting factor, right? When you go to higher studies, you will learn how to calculate the discounting factor. But for y'all, it's given in the exam. This discounting factor includes that 10% interest. So that is why you should not consider another, you should not deduct interest, right? And depreciation and non-cash expenses are not considered as, right? Why? Because these are non-cash expenses. You don't get cash for them, right? Yeah. So let's look at under each of these cash flows. Okay, when we say initial investment cash flows, what does it contain, right? So this is mostly in year zero. In your, I mean, you would have done maybe at least 1 or 2 investment appraisal questions. So you have year zero, right? In that, these are the cash flows which comes under that. So basically, just give me a second. I think there's a question. Yes, so I think one question was, we add depreciation when profit is given. Yes, if they give profits, I mean, like just like in the cash flow statement, you start with profits, you add depreciation and you arrive at cash flows. But in the cash flows instance, you don't include depreciation as a separate line item when you're evaluating cash flows, right? If you have given profits and you want to reach cash flows, you want to calculate cash flows, then you add depreciation. But don't calculate depreciation as a cost and deduct it in your investment appraisal, right? That was my point here, right? You don't consider it, means you don't calculate depreciation as a cost and deduct. Now in your income statement, you generally do that now when you calculate profits, but in investment appraisal, you don't calculate depreciation as a cost and deduct it, right? Depreciation is not considered there. But let's say in the question, just like someone rightly said, if they give profits and you want to go to cash flows, then you add depreciation, right? So that we will see in the few, in a little while in the questions, right? Yeah. So under initial investment cash flows, the certain cash flows which come under that is basically the purchase price of the machine, right? How much are you paying for the machine? And you will consider the transport and installation costs. Why? Because those all are part of the costs of the machine, because you need to bring the machine from the maybe if you're importing it from another country, you need to bring it from the harbor to your factory, right? So there's a transport cost. Maybe you need some special expertise to install it. So all of this needs to be considered. And you will consider your initial working capital requirements as well. Maybe to start year 2, right? You might need certain, start year 1 to run operations in year 1, you might need certain funds to run your day-to-day operations, to pay salaries. So those are called working capital. So you require it generally at the start of the year. So that is why year 1 working capital is given out in year 0 itself. So that is why we take it as an initial investment in year 0, right? So these are all cash outflows, right? These all are costs, cash outflows. But we might have an existing old machine in our factory. So then we can sell it and maybe recover some amount. We can recover our cost, right? So then we deduct that sales proceeds from an existing asset if you have. But sometimes the question can say you might have to pay a tax on this. So first of all, once you have your sales proceeds, first deduct your tax. Let's say your sales proceeds is 100, your tax is 20. So 100 minus 20 is 80. That entire 80 needs to be deducted, right? Because that is the amount you're earning from the that is the amount you're getting as a cash inflow, because the rest of these are cash outflows. And then you get your total initial investment, right? So this is how much will be going out in year 0 in your investment appraisal. So operating cash flows are basically what are the cash inflows and outflows you will earn during the project, right? Like revenues, variable costs, fixed costs, all of these, right? So revenue is a cash inflow, but variable cost, fixed cost, taxation, all of these are cash outflow. So you need to include both of it and calculate the net cash flow, right? Yeah, any questions? Sorry. Right. Okay, so I'm just going through this tute. So let's just quickly go through it and then we'll go to the questions, right? So terminal cash flows is, like I said, which comes at the end of the project. right? That is generally, if let's say if the question says your lifetime of the project is 5 years, that means cash flows which come in year 5, right? So these are cash inflows and outflows at the end of the investment. So stuff like disposal of the machine. The company might say you can sell this machine for 200,000. The scrap value, the residual value. So that is that, right? And generally, when you invest in working capital in this initial working capital requirements in the first year 0, which we spend out, there's a cash outflow that we can recover at the end of the project, right? We make that assumption, where when you there's a cash outflow in year 0, that same amount can be recovered in the last year of the project, right? So working capital which you recover also has to be included under the final year, right? So that is relating to cash flows overall, because the next two methods, which is payback period and NPV, we are going to learn is based on cash flows, which is why I want to give you guys an idea on how cash flows work. Now we are going to see when these cash flows come into these methods, how do you calculate an investment appraisal under these methods, right? So payback period. So like I said, ARR and payback period are not much tested. You might get it once, but mostly tested in the past several years is mainly in net present value NPV, right? So of course, in the entire lesson, spend more time practicing those questions, but of course, know how the formula or the calculations work for payback period and ARR as well, just in case you get it in paper 1, right? So payback period is basically how long, let's say you invest, right? How long would it take for you to recover that investment, right? Let's say you give someone 1,000 rupees to your friend, right? And he said, I'll pay you 200 rupees a month. So that means it will take you 5 months to collect that money. Nowadays, you don't even sometimes get money from your friends, I think. Get it back if you give it, right? So that is what payback period calculates. It calculates the time period it takes to recover that investment, right? So how this works is basically the decision rule is how do you know whether to go ahead with the project or not? Let's say you calculate the payback period. Let's say it takes 5 years to recover the investment, right? Let's say, how do you decide whether to go ahead with the project or not? What you'll be doing is you will accept any project which will pay back within a specified time period. So let's say the company says any project within 10 years, if they pay us back, we will accept the project. So if you're going to get it within 5 years, you will definitely go ahead with it. So like that, right? When comparing two projects, select the project with the fastest payback. That means the lower number of years. Let's say you have project A and project B. Project A says it will take 3 years to recover. Project B says it will take 5 years to recover the investment. Which one will you go ahead with? The project with the fastest payback. That means the lower number of years, which means project A. Why? It takes only 3 years to recover the investment, while the other one takes 5 years, which is longer, right? So that is how you make that decision. So this payback is also tested in several ways. One is if your project has constant cash flows. Let's say every year you invest 1,000 rupees or $1,000, whatever. The project will pay you back 200 rupees each year. So it's a fixed amount for a fixed period, right? Every year you will get 200. In such a scenario, you can use this formula to calculate that, right? Your investment is 1,000, you divide it by 200, it's 5 years. 1,000 divided by 200 is 5 years, right? So that's your payback period, right? So that's pretty straightforward. But let's say if the project is not an exact number of years, that means let's say you invest 1 million, that is your investment, but every year you're going to receive cash flows of 350,000. Now 1 million divided by 350, it's not a round off amount, right? You get some decimals. So then how do you calculate payback, right? So you can use the normal formula, right? Just like the previous one, you get 2.85. So basically it will take 2 years, 2.85 years. So what you do is you calculate 0.85 years, you convert it into months. By how do you do that? By multiplying by 12, because 1 year has 12 months. So that means that gives you an answer of 10 months, right? It says 10.2, you can round it off to like 10. So the payback period is basically 2 years and 10 months. In the exam, do not write 2.85 years, right? You need to convert that decimal portion into months, right? Now, these first two scenarios, we consider that if the amount of cash flow you receive is fixed, right? 350, 250, like that. But what happens if there is uneven cash flows? That means this year you get 200, next year you get 300, maybe after that 500, it can be different cash flows. In such a scenario, we will list out the cash flows in a table and then start to calculate, right? So I will be doing this using a question as we go on, right? So there are some questions in this tute, so maybe once I send the tute, you guys can practice it as well, right? So what are the advantages and disadvantages when you come to this method, right? So it's simple and easy, right? It's just a few cash flows. You can easily do even through a formula. You can calculate how long does it take to recover your investment. It's nothing, no big complication, right? And this uses cash flows and not profits. So that is a good thing, right? Because cash flows is, you can't manipulate it. Helps minimize risks and maximize liquidity, right? So what it means by that is you can easily identify how long does it take to recover, right? Then you will know, okay, how long will my funds be gone to? Let's say if it takes 3 years to recover your investment, okay, you will know that 3 years I won't be able to use that money for something else, right? So that helps you calculate what is the liquidity period, how soon can I recover my investment. And it is useful in rapidly changing environments, right? So what that means is basically like in the tech sector, things develop very fast. So these methods are very useful there because this considers how fast you can recover your investment, right? Before another competitor comes and creates a similar product like yours, right? So those are the advantages. Disadvantages are it ignores returns after the payback period. Once you calculate and let's say you recover the investment, right? It just ignores any returns you get after that, right? So once we do some questions also, I will explain that. Ignores time value of money. You don't use discounting or discounting here. It again just considers cash flows as it is. Now here in this example, there is 60,000 you will receive in year 5. It's not true, right? When you're evaluating the project today, the 60,000 you get in 5 years is not the same amount you get today, right? It ignores profitability. It's a double-edged sword. I mean, they say cash flows is good, but then again, a disadvantage is you ignore profitability, right? And again, there is no definite investment signal. It doesn't tell you on your own whether to invest or not. Now, say this project says you will recover your money in 2 years and 10 months. Is it good or bad? You don't know. You need to compare it with something always. So that is why ARR and payback period, it's two weak methods, and that is why NPV is considered the best method, right? So let me just quickly run through this time value of money, basically where you come into this concept called discounting, right? You already have used these sometimes, calculations, discounting factor at 10%, 15%, and where you discount the future cash flows, right? So that is called time value of money, right? Basically, I've shown an example here where you have your discounting factor and you have a certain cash flows and you multiply the both to get the present value. What that means is basically now let's say this, you are expecting 30,000 rupees in year 3, right? But why are you discounting? Because the 30,000 you get in 3 years is not the same amount you will get today, right? So you discount it so that you can bring all the cash flows into one platform, into one level, or into a common period of time. That is why you discount it, right? So that you can compare it with other projects and other cash flows, right? So I think just moving through that, I will go into the NPV, which is the main method, and then we'll move on to the questions, right? Because that questions is where you really apply and you can test your knowledge. So I'll just quickly run through this. The NPV represents the surplus funds earned on the project after funding the investment, right? An important assumption is that all cash flows occur at the start or end of the year, right? So NPV, it says net present value. Whenever the word net comes, it's always deducting something, right? Like net assets, that means assets minus liabilities. Even in these products you buy, let's say a biscuit packet, it says net weight. That means they deduct the weight of the packet, right? So net means anything which you are deducting. So here the definition says that any surplus funds, right? Like any profits, or like not profits is not the appropriate word. I would say surplus funds, any cash flows above your investment. Let's say you invested 1 million. You're supposed to get cash flows of 1.5 million. Then what is your surplus? That extra 500,000. That is your NPV, basically, right? It is also assumed that initial investment takes place at year 0 and all of the cash flows start 1 year later. That means year 1 onwards, right? All these assumptions hold unless otherwise stated by the examiner. So you will assume these unless the examiner specifically states something different. So how do you, when you do an investment appraisal, how do you evaluate this, right? So if your NPV is positive, like I said, that 500,000 example, then you will go ahead and accept the project, because you know you're going to get 500,000 extra definitely if you invest in the project, right? But if your NPV is negative, you're not going to earn anything. So might as well reject the project, don't accept it. So in the exam also, once you do the calculation, they will tell, please recommend the project. What is your recommendation? So you need to say whether you will accept it, reject it, right? And if the NPV is 0, that means you're breaking even. So it's your choice whether you want to accept it or not, but it doesn't make sense to accept a project where you're not going to earn anything. If you're going to spend 1,000 and earn 1,000, what's the point, right? When comparing two projects, always select the project with a higher NPV. Project A NPV is 500,000, project B NPV is 700,000. Go and select project B. It's giving you a higher surplus, a better cash flow, right? So yes, just come to the end of the tune. So there are some advantages and disadvantages in this. So the advantage is basically definitive investment decision. It directly tells you how much you will earn. Like I said, if your investment is 1,000, you're earning 1,500. That extra 500 you will definitely earn. You don't need to compare it with anything like that. So it gives a definite investment decision. Right? It considers time value of money. You discount it. You don't discount all the cash flows to present value, to today's value. It considers returns of the whole life of the project. Let's say your lifetime of the project is 5 years. You calculate the cash flows for all 5 years, and you use all 5 years of cash flows in your NPV. Because I said in payback period, they don't consider all the years. They consider only the years until you recover your investment, right? So, and it uses cash flows, not profits. And this leads to maximization of shareholder wealth. So that means what it means is, let's say if you earn that extra 500, it directly tells you that your shareholders will earn that 500, right? There is no percentage or anything like that. It directly tells you how much dollar value you will earn. But some of the disadvantages, it can be a little complex to calculate. I mean, in the exam, you all have a simple format, simple method, what you all learn in A-levels. Practically, it's a little complicated, right? And it's difficult to explain to non-financial managers. People who don't understand finance may not know these words or these calculations, so it can be a little difficult. And estimating the cost can be difficult. When I say cost, I'm talking about discounting factor, that 10%. Sometimes it's difficult to calculate that, right? It's not straightforward as they give in the exam. For y'all, they give it, but practically it can be a little difficult, right? Are you guys okay with this? Any questions until now? Please feel free to unmute, I think, or type in the chat. Are you guys okay with everything we discussed until now? So then we can move on to the past papers. I hope you all have past papers from 2011 to 2020. You are about 2 months away from your exams. So I hope you have your past papers, right? So I'm not getting any messages on the chat or anything, so I'm assuming you guys are okay with it. So we'll move on to the past papers, right? If that's okay. So just to start off with a basic question, right? Just to give a, we've been discussing theory, so let's just do a basic. Okay, I think there is one question. Just give me a second. Okay. Everyone's all okay, right? So just to start off with a basic question, we'll turn to 2011. Okay, so I think there's a question. 1 second. Okay, so where do we record reinstallation cost? So that will depend. So sometimes the question will say in year 2, the company will incur this much of cost. It can be a one-off cost, right? But sometimes they will say in the relevant year, right? If it's installation cost, that means it will go in year 0. If they give something called the reinstallation cost, which I don't think seen in your A-level papers, they will tell you in the specific year. The company might have to reinstall or maybe repair or certain maintenance cost in this specific year. If they tell it in a specific year, include it under that relevant year. If it maybe it's year 2, put it under year 2. If it's year 3, put it under year 3, right? But if it's installation cost, you put it in year 0, right? Okay, so wait, once again, I'm getting a few messages on questions. Someone is asking, what is operating savings? Is it an inflow or outflow? So it is an inflow, because as a result of using or implementing this machine, or buying this new machine, you're going to save a certain amount. So you consider it as a cash inflow, because you're saving some money. No, you're not. That money is not going out. So if it's going to be with you, it's an inflow, right? It's like an indirect inflow. You're not getting the money from somewhere, but money not going out means you're kind of saving it. So it is an inflow, right? I hope that's clear. Another question: in the last year, increase in Yeah, so there's in the last year increase in working capital from 200 to 250 means why we had only the change instead of recording the 250. Because let's say the question they will say your working capital is 200 and because of implementing this project it's going from 200 to 250. So because of this project, only your working capital is increasing by 50. Otherwise, you already have a working capital of 200. That is why we add only the 50 at the end of the period. We don't add the entire 250 because out of the 250, 200 is maybe to your normal day-to-day operations. That 50 is what you incurred for this project only. So in investment appraisal, you need to include cash flows which are considering only for the project. I don't go and include you are not going to include a revenue or a cost from another project. No? Like this. So that is why we record only that change, the 200 to 250, that extra 50 is why we record, right? Not the entire 250. I hope that's clear. Any more questions? Cool. Right. So then, yeah, okay, so no questions. So we'll move on. So please turn to the 2011 paper. I hope you guys have it. I'm also using a book, so I can't screen share it. The 2020 paper, I have a soft copy, so I'll be putting it on the screen. But unfortunately, 2011, I have it on a hard copy, so you will have to look at the book, right? Right. So let's turn to 2011. Right. So and let's. This is question 5, part B. Right. 2011, question 5, part B. So yeah, I hope just give a minute for everyone to turn into it. Right. So let's go through it. Right. So a company expects to manufacture and sell LED televisions for a period of 3 years. So that's pretty much the lifetime of the project, 3 years. The following information relates to the project. The amount incurred for a market survey was 200,000. So you have incurred a market survey. I think we discussed what this is. What is it? A sunk cost, which you won't include in your investment appraisal calculation. The expected investment in machinery to manufacture televisions is 1.2 million. At the end of the third year, 1/4 of this value will be realized. So your investment is 1.2 million. You will realize 1/4 of it. That means 300,000 is scrap value or residual value. You can sell it for that amount. Sometimes they call it realizable value, right? It is expected to incur 100,000 for replacement of machinery parts at the end of year 2. Like that's, there can be some ad hoc expenses in the middle of nowhere. It won't occur every year. They can maybe give 100,000 like that. So that you will incur in year 2 for some replacement. Right? The working capital of the company will increase from 200 to 250 due to the project. The additional working capital will be realized at the end of the project. So here the question has been very specific. They say the additional working capital only will be, you will receive it at the end of the project. Right? So I think that directly gives you that hint of, I think, what we discussed just now. The expected production and sales per annum are 50 television sets. So that is your quantity, how much you want to produce and sell. The expected selling price is 100,000. Expected variable cost is 80,000. Fixed cost of the project, inclusive of machinery depreciation. Now these all are small hints which they are giving you, right? When you read a question, when they say stuff like this, okay, it's a hint. Okay, I mean, I need to be careful of this, and maybe it's a hint to maybe remove it or include it. You need to figure that out, right? So your fixed cost is 800,000 including depreciation. Your required rate of return of the project is 20% per annum, and the discounting factors are at 20%, right? So they have given the discounting factors for 3 years at 20%, 0.8, 0.7, 0.6. Required under number 1 is computation of annual cash flows of the project, right? So that's a calculation. Let me come back to that. Let's just quickly go to step 2 because that's a writing part, right? So number 2 says 2 cost items irrelevant to the evaluation of the project, right? Irrelevant to the evaluation of the project. So what was one we discussed earlier when we read the question? Market survey. It's a sunk cost, 200,000. What else is not considered in your investment appraisal evaluation? So I said we don't consider depreciation, right? Why? Non-cash, it's not deducted as a cost. Of course, we will consider it if there is profits given and all that. That is a calculation, but it's not considered as a cost, right? It's not deducted as a cost, just like an income statement. So that's 2 of it. Then what else is not considered? I think just now a student asked on that 200,000 working capital. That is also not considered. We don't bring that entire 200 here because only 50,000 is required as working capital, right? So that's, I just want to touch on that second point, the question number 2. So let's go back to question number 1 and do the computation for these cash flows, right? So they're asking computation of annual cash flows of the project, right? Computation of annual cash flows of the project. So let's quickly put up format. Basically, you can say year 0, year 1, year 2, year 3, right? You have 4 years. So including year 0, it's 4 years, but year 1 to 3 is the lifetime of the project, right? And when you're doing questions in exams, try to be neat. You're in a hurry, I know, but just try to write things. And just some tips also. You don't need to go in order in the exam. You can even start, if you're comfortable with the investment appraisal, just go and start with that question, right? Right. So we need to basically list out all the cash flows in the question, right? So let's read from start and see what are the cash flows. So first one is the market survey. We don't include it. Second one, investment in the machinery. So you can say investment. How much is it? So I'm going to do the question in thousands. In the exam also, if you are doing it, please mention that on top, right? And I would recommend to do it so that you don't waste time writing zeros, right? So investment is minus 1,200, right? And you have a realizable value. And the end of the third year, it says 1/4 of this will be realized. So basically, you can say scrap value in the third year is 1/4 of that, which means 1,200 divided by 4, which is 300, right? So I hope you're okay until here. While I'm doing, if you all have any questions, please type on the chat. Next one, it is expected to incur 100,000 for replacement at the end of year 2. So there's a question, I think. Okay, someone's asking the question number. This is 2011 paper, question 5, part B. 2011, question 5, part B. No, someone's asking if we do it in thousands, do we have to follow the same method for other questions? No, but if you are doing it for each question, you can mention. But you can do in thousands for this one and not for another one. But if you want to do it in thousands, above each question, mention that you're doing it in thousands. Right? Just because you put it into one question doesn't mean it's applicable for all. Right? Next one is, I think it says replacement cost. Right? There's 100,000 at the end of year 2. So I will say minus 100 there. Right? So I'm going to do all of this. Just let me put this in brackets so that it's clear. It's a cash outflow. Right? Working capital of the company will increase from 200 to 250. So I'm going to say working capital. In year 0, it will be minus 50. And in year 3, it will be plus 50. So I think there's another question. Oh, sorry, really, you can't see your screen. Sorry, guys. I'm really sorry. Okay, now it's visible. I'm surprised I didn't get that message earlier. Right, sorry about it, my bad. I forgot to switch screens. Right, so this is the format year 0 to year 3. You will start putting the cash flows under each relevant year, right? So we investment minus 1.2 million, scrap value you have 300,000, which is, if you see the formula here, 1/4 of that value. Replacement cost, sometimes in panic mode in A levels, students might divide 1,200 divide by 3 because they think 4 into 3 is 1,200 and they might put 400 here. So be careful of these small errors, right? Replacement cost minus 100 in year 2. Working capital, it will go out in year 0 and you can recover it in year 3. What's next? Expected production is 50 television sets. Okay. What is your selling price? So you can say revenue. Right? You will earn from year 1 onwards. How much is that? 50 units into basically 100,000. Right? So that's 5,000 and you will be earning that throughout all 3 years. They haven't given different television, the quantity in different years. They haven't done that. 50 units every year. Right? Then you will have your variable costs. Right? How much is that? 80,000. So it will be 50 units into 80,000. So I'm going to put that as a minus 80 so that it comes in bracket. It's a cost. It's an outflow. Right? What's next? Fixed cost. So I'm just putting it FCVC. It's fixed cost, variable cost, right? You don't. In the exam, I think there's not a problem. You can use it because you're stuck for time, so you can use these These are generally used across finance and accounting, so don't worry about, you won't get marks cut or anything like that. Right? Fixed costs, it says 800,000, but this includes depreciation. But like I said, we don't include depreciation, so we need to remove depreciation from this 800,000. How do we do that? We calculate depreciation. How do we calculate depreciation? We take the cost of depreciation. What is the formula? So we go with straight line method, right? Cost minus scrap value divided by lifetime, right? Useful economic life, lifetime. So these are different words, right? So this, your cost is basically how much? 1,200. Your scrap value is 300. You will divide it by 3 years, right? So 1,200 minus 300 is 900. 900 divided by 3, that gives you an answer of 300, right? 900 divided by 3 is 300. So that is your depreciation. So you need to remove 300 from this fixed cost. So your fixed cost is 800,000. You remove 300,000, then your fixed cost is how much? Minus 500, right? So it's going to be 500 for all the years, right? And then they have given us the discounting rate, right? So pretty much they have given, I think we have included all the information. I think there's a question. Should the depreciation be added because the formula says profit by depreciation is cash flow? No, you don't need to add that like that, because here they have already, so in your investment appraisal, right, when you're putting your cash flows, you're not going to consider depreciation as a separate cost, right? You're not going to put minus depreciation and you're not going to deduct it as a cost, right? You don't need to add it back as well, because you're not calculating profits here, right? You're directly going for the cash flow. So you can leave depreciation out, but depreciation in this question is already included on that, inside that 800,000. So if you put minus 800 here, it's you're taking depreciation. That means you're deducting depreciation as a cost. So you need to remove that, which is why we take minus 500. We're removing the depreciation part. So that is why you put as minus 500, right? So I hope that's clear. If there is any questions, please ask or let me know. So what you need to do is you can even finally calculate your net cash flow, right? So basically that's like the total for each year, right? So of course I'm using some formulas because it's on Excel, but be careful in the exam when you all calculate this, right? So your first year there's a cash outflow is 1,250, then you're earning 500, 400, and 850, right? That's how it is. I hope the previous question I answered is clear why we don't include depreciation. If you're still not clear, please let me know, right? So these are your net cash flows, and that is what question number 1 is asking as well. Calculate the annual cash flows for this project, right? So number 2 we already answered, and finally number 3, net present value of the project and recommendation on whether it should be accepted, right? So students, what they tend to do is they forget the balance part of that question. They just do the net present value and they forget to recommend it because it's part of it. So please be careful when you read questions to make sure you have included, you answer the entire question, right? So what are our cash flows? So we have, we can state this is the year, we have the cash flow, we have the discounting factor at 20% and the present value. So we put like a table format. So we have year 0, 1, 2, 3, right? And then what are your cash flows? That is what you just now calculated, right? Your minus 1,250, your 500, the 400, and the 850, right? This is a pretty basic question, right? So if you guys, I think that's, I just chose this for a start off, right? So in year 0, the discounting factor is always 1, right? Year 1, they have given us a discounting factors 0.8, 0.7, and 0.6, right? And then what you do is you multiply your cash flow by your discounting factor, right? And then you total it up. So you get an answer. Your NPV is minus 60, right? So that means you have a negative net present value, right? So that means, will you accept this project? What is your recommendation? No, we will not accept this project. Is that clear? Everyone's okay with this? If you all have any questions, so this is just a basic one I chose just to start off before we go into the other ones, right? Right, cool. So I think some of you all are messaging understood. Cool, right? So I'll move on to the next one. If you all have any questions, please let me know, right? So let's go on to the 2013 paper, right? So again, there's a bit of a different. So why I chose this question is because you have all the methods, investment appraisal methods in this question. They have tested payback period, ARR, and NPV, right? Which is why I chose this method. Okay, cool. So some of you are saying it's clear. Right. So turn to 2013, question number 7, part B. The last question in that paper, right? 2013, question 7, part B. Yeah, so I hope we are clear. I'll give a minute to find the question. 2013 paper, question 7, part B. Right. Excuse me. Right. So yeah, so part B, let's read through the question and then we'll see how to calculate this, right? So the reason is I chose this the question is, like I said, all methods are tested here, and then you can practically apply and see what we studied just now a little while ago in the tute. How do you calculate this, right? Because sometimes when you study it, okay, you know it, but when you try to calculate it, you get stuck somewhere, right? Yeah, so a company is considering to purchase a new machine in order to enhance efficiency of its production process. The following information is available in this respect. Number one, so under that they have given us the cost is 1 million, useful life 5 years, residual value 100,000, annual maintenance cost 50,000. So every year you will have a maintenance cost of 50,000. An amount of 250,000 could be saved annually on direct labor costs by using this machine. So they may be automating the process. So you are having a saving of 250. So that is kind of like your cash inflow, right? If the new machine is bought, the old machine could be sold for 150,000. Discounting factors at 10% is given in relation to the above project. Under the requirement, what is required is, number one, cash inflows and outflows for each year, right? Inflows and outflows for each year. So you can start putting the inflows and outflows similar to the format which we did earlier, right? So you can I'm just going to copy these years. So here the useful life is 5 years, right? So you can, when you're drawing the format, make sure you include year 4 and year 5, right? Right. Right. So you can say on top cash inflows, and then you list out all the cash inflows, right? And then at the bottom, after a few lines, you can say cash outflows, right? Because they're told to list out cash inflows and outflows for each year, right? So let's read through the question from top and see what are the inflows and outflows, right? Cost 1 million. So then you can say investment. So that is not an inflow, sorry, it goes on outflow. Investment 1 million, that is in year 0. Like I said, let me put all of this into brackets. Then you will see it as a negative, right? Investment 1,000 in year 0. Residual value 100,000. So that is an inflow, right? Residual value. Why? Because if you sell the machine, you can get 100,000, right? Next one, annual maintenance cost 50,000. So I will say maintenance cost 50,000 is the cost, so minus 50, and that will be there for 5 years. Next one, an amount of 250,000 could be saved annually on labor cost by using this new machine. Directly, it's like an income for you, right? So then you say savings, you can say direct labor cost savings, that. How much is it? 250. So annually you can save 250, right? So I hope it's clear. It's pretty straightforward and basic, but you need to read the information carefully and put it onto the template, right? If the new machine is bought, the old machine could be sold for 150. So that is another inflow. Sale of existing machine. How much is that? 150,000. We put it under year 0 because then we can sell it in that year itself, right? So that's about it. We have gone through all the cash flow, so that pretty much covers all of it. So what you need to do is you can take the total under each, right? So basically the net cash flow, right? So you can just add up. You can add all of this, right? So there's net cash flow, right? Yeah, so we have minus 850, then 200,000 each year, and then final year we have 300. Why? Because of the residual value coming in, right? So I hope that's clear, because that is what the requirement number 1 has asked in the question, right? Let's go. I hope there is if there are any questions, please ask me. Otherwise, I'll move on to part number 2, right? So next one is payback period. So they want us to calculate the payback period. So let's see how to do that, right? So I'll say number 2, payback period. So how do you do that? You will list out the years, the cash flows, and you will list something called the cumulative cash flow, right? So these are the 3 columns which are needed for this, right? So how many years do you have? You have 0, 1, 2, 3, 4, 5, right? What are your cash flows? These are your net cash flows, right? So I'm going to paste it here. Right, so these are your cash flows, which we just now calculated for the 5 years. So what is cumulative cash flow? So this is basically how we calculate our payback period, right? So we assume we have totally spent or invested 850,000, and as we go on every year, we are recovering some money, right? Some funds. So we are checking how much is left to recover. That is what cumulative cash flow means. So what cumulative cash flow is basically, by end of year 0, we have invested 850,000. But by year 1, right, we earn 200,000. So we have 650,000 remaining to recover. Out of 850, we recovered 200 in year 1. So we have 650 less. So cumulative cash flow is what calculates that, right? And then again, out of 650, we receive 200 in year 2. So then I have balance 450. Minus 650 plus 200, which is a minus 450. Right? If you all have any questions or clarifications on this, please let me know. Right? So next year also the same thing. We have 450 remaining. You earn 200. You have remaining 250. Right? So you will keep doing this until you arrive at 0, closer to 0. Right? So here you have 250 left, and next year you're earning another 200. So you still haven't reached 0. Right? So now you have remaining 50. Now next year when you earn 300, your entire investment is covered and you're actually earning more than your investment, right? So you will calculate until there, right? So now you can see how many years it has taken you to pay basically recover this investment. That is the payback period. It has taken you 1, 2, 3, 4 years. It has taken you 4 years to recover. So I will say 4 years. We are not done because you still have 50,000 more to recover, right? So how do you calculate this in months? Now you will recover this in the year 5, no, but you might recover it within the first few months itself. You don't need to wait until this entire 300 come. As cash flows come into the business, you can recover that 50. How do you do that? How I tell students is you take 50, the remaining cash flow which you have to receive, divided by 300. That is the next cash flow you're going to get. So 50 divided by 300. into, you convert this into months, into 12 months. Then what is the answer you get? 50 divided by 300 into 12 is 2, right? So it's exactly 2. So it will be 4 years and 2 months. There's a question, 1 second. How to get 1400? I'm sorry, where is 1400 here? Someone has asked how to get 1400. I'm not sure where there is 1400 here. Check if there was a typo error on your end. There is, yeah, so I'm also not sure. There's no 1400 here, so if in case you just typed it wrong, let me know, right? Yeah, so it takes 4 years and 2 months to recover this investment, right? So you calculate the number of years, and in the remaining amount, you converted it into months, and you got 2. So it's 4 years and 2 months. You can't leave the question only at 4 years. You need to calculate for the remaining amount as well, right? So I hope that's clear. I'm moving on to the next question. Let me know if you all have any doubts, right? I'm sorry, this 1400, I'm still not sure where you got the number from. Retype it again, right? If there's an issue error, right? So the part number 3 says calculate ARR basically. So you need to calculate ARR, right? Accounting rate of return, right? So how do you calculate this? What is the formula, right? ARR equals average annual profit, right? One second, I think there's a question. Okay, so how to know what is the amount we have to recover? So that is basically your investment. That is what you're trying to recover. That is why you have year 0, you're investing 850, and that is what you're trying to recover here. You're trying to recover this investment. So that is why in year 0, you have totally invested 850. And year 1 onwards, you're starting to get cash flow. So you're starting to recover your money. That's why the investment is reducing. The amount you invested, it's reducing because you're starting to recover it. I hope that's clear. So how to know the amount we have to recover is basically your investment in year 0, right? That is the amount we have to recover. So is depreciation added in the annual maintenance cost? No, we don't consider depreciation because the annual maintenance cost, they are just telling or talking about annual maintenance cost. They haven't said depreciation is included. They have not told anything about depreciation. And we don't consider depreciation also because we are calculating cash flows. So because they have not told it's included, we are not removing it as well. If they have said depreciation is included, we will remove it. But because they haven't told that anything separately, we are not going to assume. Don't assume, please. We are just going to include the cash flows which is given, right? And we are going to calculate net cash flow. And we are not going to include depreciation as a cost. Why? Because depreciation is non-cash. You don't pay someone called depreciation. You don't pay someone here is depreciation, right? So that is why we don't include it in the investment appraisal. I hope that answers both of the questions, right? Yeah. So we were at ARR. So here we calculate average annual PBIT divide by average investment. So let's calculate the numerator first, and of course into 100, right? Don't forget that. That is to turn it into a percentage, right? That is why you multiply by 100. So what is the average annual profits? Okay, so here they want, so here you need to calculate profits. Now that is where a bit of a calculation comes in. All this time we had cash flows, but in this situation we have to calculate profits, right? So what I'm going to do is I'm going to take these cash flows, I'm going to paste it here, right? I'll tell you why, because now we are going to calculate profits. So how do we do that? Oh, the light is not an issue for you guys, right? So when we calculate average annual profits, these are for each year, right? So we will consider only year 1 to 5 in calculating profits, because year 0 you don't earn anything, no, right? So I'm just going to delete this year 0 part off, right? Because you don't really earn anything. So let me just delete these columns as well. Give me a second. Yeah. So these are your cash flows for the 5 years. But now what do we need? We need profits. Why? Because to calculate ARR, we need annual profits. There's a question. So ARR is to be calculated on initial investment according to the question. Yeah, so let's look at the question. Now it's based on initial investment. Sorry about it. I didn't see that part. Yeah. So we can go ahead with initial investment, not average investment. Initial investment, right? Just don't worry about spellings. I'm just typing it fast, right? So from cash flows, we need to go to profits. How do we do that? In the cash flow statement, what do you all do? You all start with profits, then you add depreciation and go to cash flow. Now we are doing the reverse order. We are going from cash flow to profits, which means we need to deduct depreciation because you are moving in the reverse order. You used to add it, now you need to deduct it. So hence we will calculate depreciation and deduct it. How much is depreciation, right? So our investment is 1,000, right? We have a scrap value of 100, right? So then 1,000 is your investment, your scrap value is 100, right? So let's calculate depreciation here. Cost minus scrap value divided by lifetime, right? The useful life. So your cost is 1,000 minus 100 divided by 5. So 1,000 minus 100 is 900. You divide it by 5. I'll just straight away get the answer here. 1,000 minus 100 is 900. Divide by 5. Your depreciation is 180 per year. Your depreciation is 180. So what you do is you deduct 180 from each year minus 180 from the cash flow, right? So that will be applicable to all years, right? Some students might ask, they may get confused, right? Because here we have included cost of 1,000, but they will see in the cash, the investment appraisal, we had a sale of existing machine, right? Of 150. Why don't we deduct that from the cost? No, that is not part of the cost of the machine, right? That is just part of year 0 as an outflow. That is separate. Cost of the machine is only 1,000. If you have transportation cost, installation cost, then use that, include that. Don't include sale of existing machine. That is not part of the cost of the machine. That is just another income for you, right? So be careful of those small errors, right? So so we'll get our answer here. 200 minus 180 is 20, right? So this will be your profits, right? Profits for each year. We need the average annual profit, right? So that will be basically, you will add all these profits and you divide it by 5. So you will get 40. What I have done is I've added all the profits and I've divided it by 5 because I need the average. I divide it by the number of years of the project. So it's 40 divided by, they have asked for the initial investment, right? So what is your initial investment? So that in that relevant year, the examiner has given marks for both. Some have included your investment as 1,000. Some have taken this 150 also and deducted and included as 850. So your answer is correct for both, right? Your initial investment is 1,000. You can even you can even do it as 450 divided by 850. How did I get this 850? My investment is 1,000. I recovered 150 by selling the machine. So the balance is 850. Right? So so can you please explain how to calculate PBT? Okay, so profit before tax, right? So here all this time we calculated cash flows, right? We had cash flows and now we have to calculate profits. Why? Because this ARR requires you calculating profits. That equation asks for profit, that formula asks for profits. So you have to go from net cash flows, you have to calculate profits now. How do you do that? There is one item to add, which is what? Now in your cash flow statement, right? What do you all do? You all start with, let me just show it here. You all start with profit before tax. Then you add depreciation. And then finally you all arrive at cash, right? At the bottom, you all put cash and cash equivalents at the end of the year, right? So let's say this was 100, you added 20, you have 120 as total. But right now you have cash flows with you and you want to go up. You need to calculate profit. So you're working it backwards. So from 120, how do you go to 100? You need to deduct depreciation. 120 minus 20 will give you the profits. So that is what I am doing here as well. From my cash flow, I'm deducting depreciation so that I can get my profit. That is why 200 minus 180 is 20. That is how I get my profit for each year. But the formula says what is the average annual profit. So I will have profits for each year. I will take the total of everything and then divide it by 5 to get the average annual profit, which is what I've shown here. I will sum means I will add all of this from the 24 years and 120 in the 5th year, and I will divide it by 5. And then I will divide it by the initial investment of 1,000. Some students have used 850. That is considering the 150 machine sale. Still, it's correct. And then you can get your answer. 440 divided by 1,000. You multiply by 100. You will get 4%, right? So since you all can use calculators also, you can just divide at one decimal places, 4%. Here also you can do the same. Here you will get 4.7. No problem in the difference in the answer. It's not wrong. It depends on what you have used, and marks were given for both of them, right? So I hope we are clear. Let's move on to the next question, right? If you all have any questions, please let me know, right? So the final one, not the final one, the fourth one says net present value to calculate, and the final one says to recommend whether you should purchase or not, right? So the fourth one is NPV, right? NPV. So here also we will use a similar format like the payback period. Just going to copy this, paste it here. We have taken all the information. Yeah, so I think here we have the cash flows. Here I will say discounting factor at 10%, and I will start putting the discounting factors, right? 1.91, 0.83. So these are all showing 1 is because of the decimal places. 0.83, and 0.75, 0.68, 0.62, right? So yeah, and then you calculate present value, right? And then how do you calculate present value? The cash flow into the discounting factor, right? So you do it for each year, right? So for every year you multiply 200 into 0.91 and 200 into 0.83. So like that you will keep multiplying and going, and then you total everything up and you will arrive at your NPV of minus 30. This is your NPV, right? So this is your NPV, and what is your recommendation? Since it is negative, we will not accept the project, right? Because it has a negative NPV. So you can see if you get the first one right, you can get the other things right as well. So in case you forget to include one item, that's going to affect your payback period. That's going to affect pretty much everything, right? So especially NPV as well. So make sure you are careful when you're including each of these, including the correct year, the relevant year, right? So I hope you're okay with that. So let's move on to that. If you all have any questions, please ask. While we are doing that, let's move on to the 2018 paper. So that has an interesting question. Why I chose that is because when you get questions like this, students tend to panic, right? Where they have already given the NPV and they're asking again for an NPV. So students wonder, what should do? Where should I start? Should I start calculating for the beginning again? Stuff like that. So that is why I chose this question, so that you will know to tackle this, right? Yeah. So 2018 paper, question 5, part A. 2018, question 5, part A. Right. So I hope you guys have the paper as well. So let's just read through the question briefly. A company has decided to purchase a new machine costing 4 million, and its estimated useful life is 4 years. The NPV of this project has been calculated as rupees 600,000 positive at 10% discount rate. So it's already positive at a 10% discount rate. So then why are they asking us to do something like this again? So let's see. However, the accountant of the company has later found out that the following cash flow items have not been considered in the calculation. So they have not included these. So they have given a list, right? And what is the requirement? Show the values with the annual cash flows as positive and as cash inflows as positive and outflows as negative of items number 1 to 5. So you need to use a similar format, right, given below. So again, I'm just going to copy this format which we have used here, 1 to 4. So you guys also can quickly put it down here, 1 to 4, right? For each transaction, they have given 5 cash flow items, item number 1 to 5, right, in the question above. So for each item, you need to tell whether is it a positive or negative cash flow in this format, right? So let's go through the first one, annual operating cost savings. So you have cost savings of 300,000 each year, right? So that is your item number 1. So you will say 300 each year. The question, I think. So the question is question number 5, part A, 2018. Question number 5, part A, right? Question number 5, part A. So you will. The first one is annual operating cost saving. So you have a cost saving of 300 each year. So that cash flow will come for all the 4 years. Why? Because it says annual cost savings, right? Second one, sales value of the old machine. How much is that? You will be selling the old machine for 200, and that thing comes under year 0 under the initial cash outflows. So that is a positive 200. So I can just say positive or negative, right? You need to put that mark here. Since I'm doing it in an Excel, it's a little difficult, but okay, manage it. So you guys, when you're writing, just put it as positive or negative, right? Third one, sales value of the new machine at the end of the project period. So what is the sales value of the new machine? That means what is the scrap value of the new machine at the end of the project? 500. New value is 500, right? So I'm going to put 500 here, right? Fourth one, installation charges of the new machine. Installation charges of the new machine. So here it will be minus 1,200. You need to put that minus. Why? Because it is a cash outflow. Fifth one, annual subscription payable to the Central Environmental Authority, payable from end of year 1. So year 1 onwards only, this cash flow will start, right? So it is an outflow because it's a payment. So it is minus 200. Minus 200, right? Every year. So I hope you are okay with this. You guys are clear. If there's any questions, please feel free to let me know. Right. So you can even get the totals as well, but not necessarily needed. They haven't asked for it. Yeah. Okay. So yeah. Okay. Everyone, some of them are clear. Yeah. So that is part 1, right? What are they asking in part 2? They want to calculate the revised net present value of the project at 10% discount rate. They wanted to calculate the new net present value. So is a question. So as it is end of first year, should we include it in the first year? Yes, and generally it is year 1, year 2 are given as end of first year. That is why you include it in year 1. Let's say the question says beginning of first year, then you include it in year 0, right? That is why working capital, sometimes they will say it is required at the beginning of year 1. That is why we put working capital in year 0, the initial working capital. So this, when they say end of year 1, that means these are end of years, right? This is end of year 4, this is end of year 3, like that. If they say beginning of year 1, then choose the year before. Now let's say they say beginning of year 4, that means put it under year 3 cash flow, right? When they say beginning of year 4, put it under the 3rd year, right? That's how it is. Part 2, so this was part 1. Part 2 says calculate, so basically revised NPV at 10% discount rate, and then they are asking you for the recommendations. You need to basically calculate the revised NPV. So this is where students sometimes panic and get confused, wondering, should they do the question again? They don't have information of the initial NPV, the 600, right? So not to worry, you just need to consider this as a new NPV question and then consider it. So first step what you do is you consider these cash flows as like a NPV question, right? So you put here 1 to 0, and then you can say net cash flow, right? And then what you do is you take the total of each year, right? So why it's coming 0 for me is because I have put this plus 200 minus 200. So what I'm going to do is I'm going to say 300 here, right? Because in the Excel it's coming like that. I'll say 200 here minus 1002. Give me a second, right? Because that's an Excel issue. Yeah, it's plus 500. So when you all are writing, please put it in plus or minus. Be careful, right? Right. So your net cash flow here is minus 1000. You apply the same, do the same calculation across the other years as well, right? Here it's 300 minus 200. That's the same thing for the next 3 years. And in year 4, you have that 500 also coming in. That's why this jumps to 600. And now you do a normal calculate the NPV as usual, discounting factor at 10%. So year 0, it will be 1. So the discounting, basically NPV can be calculated both ways, right? You can even do it in a horizontal format, or you can even do it in a vertical format, right? Whatever works, right? Doesn't matter. So this time I'm just doing it in the horizontal format, right? And then you calculate present value and NPV. So here they have said 0.91. The discounting factor is 0.83, 0.75, and 0.68, right? And then the present value is what? The cash flow into the discounting factor. I think there's a question, 1 second. Isn't the cost of new machine included? No. So basically they have already done an NPV, right? Oh, wait, yeah, that is the question. Yeah, they have already done an NPV and got a positive 600,000, right? And they would have included the cost of the new machine in that. We have to work with whatever the information which is given to us. So here this 1200 is basically, it's not the new machine cost, it's a repair cost, right? It's an installation or something else. Yeah, installation charge, right? It's an installation charge. So it's not the cost of the machine, it's an installation charge. So we have to work with whatever the figures which is given here, because the cost of the machine would have been already calculated when they did the initial NPV of 600,000. So here we will calculate with whatever the cash flows we have given to us in the question. So I hope that's clear, right? So that's what I'm trying to do. I'm trying to show you how do we merge these both NPVs, because there is already an NPV, you're doing another NPV. How do we merge this, right? So then you will multiply again the other cash flows into the discounting factor for each year, right? And then you will sum it up at the total, right? Basically. And you get 343,000 negative NPV. So here it's negative 343, right? So from this NPV, what we have done, it's negative 343. But what has been the issue? The accountant has forgot to include some of these items. So there you're getting a positive, here you're getting a negative. What you need to do is, that means if you had included these items along with that initial NPV which you calculated, you will get the total and the same answer. So what you have to do here is, you have a positive NPV of 600 already. You need to deduct this 343 and see whether you still have a positive NPV. Basically, you're combining the both. So 600 minus 343. How much is that? You get an answer of 257 as your revised NPV. So you're still NPV positive. Earlier 600, it has reduced now because you have considered a lot of costs, but it's still positive. You can go ahead with the project. There's a question. So can we answer both the questions in the same column? In the sense, don't calculate, don't put this working again into the same one. I would recommend keeping it separately. What you can do is, you can take the, because here when we are starting, we took the net cash flow initially. So you can just directly take that amount. You don't need to write all of this again. but don't do this calculation inside this question itself, right? If that is what you asked, right? I think I understood it that way. So don't do that calculation inside this, keep it separate. That is why they're given part 1 and 2, because they want you to use a similar format and include these stuff here, right? So yeah, I hope that is what is it, right? Good. Okay. So I hope we are clear on this. So that is why students sometimes, they calculate this and leave it here. So they're asking for the revised NPV. So you need to combine these both. Why? Because what has the error? What was the issue? You had just forgotten to include these in the previous calculation. So you had done a separate calculation. You have discounted it. Now you are just merging the both, right? That is what is happening here, right? So I hope we are clear on that. If there's any questions, please let me know. So we're done with 3 questions, and why I think there's a bit of learning in each of these. So 2011, like I said, it was just a start, just a question. 2013, we had all 4 methods. 2018, we had this new thing coming in where they give 2 NPVs and how do you combine it, right? The final one I want to do is the 2020 paper, which is interesting, where they have given some hidden information, and sometimes students get confused with the amount of information given, right? So I'll share the screen. Actually, yeah. So I think you guys can see the entire screen, right? Yeah. So I think you have your yeah. You guys can see the question. Yeah. So let's read through this and see, right? So you don't need to find the question; it's on the screen. You guys can have a look at it, right? Multi Laboratories is considering to replace the old medical testing equipment with a new modern testing equipment. So question, can you please explain 2018 MCQ 50? Okay. Let me come back to that once I do this question, right? I think if someone from Protract, what I'll do is actually, I just wanted, I think since some of y'all, obviously most of y'all haven't, I think all of y'all haven't, I haven't taught to any of y'all. What we can do is maybe at the end of the session, if Protract is also okay with it, I can give my contact number and you guys can, ask me any question in any area of the syllabus if you guys want to clarify doubts, right? If Protract's okay with that, we can arrange for that, right? So this also I'll include it inside that because I want to keep the lesson flowing on this, right? So you can ask me any doubts from any of the areas, company accounts, partnership, anything, once we're done with the session later, right? So Malik Laboratories is considering to replace the old equipment with a new one, right? If they decide to acquire this new equipment, the old equipment can be sold at its book value of 250,000. So if you're buying this new equipment, you can sell the old one for 250,000. So that is the sale of the existing machine. The estimated cash inflows and outflows of the new equipment are as follows. So the purchase price is 1,800, 1.8 million. So I'll read it in 1,800, right? Transportation is 200, installation is 75. Residual value of the end of the life. That means you can sell the new machine at the end of the period for 125. Additional working capital requirement at the beginning of the project, 275. So they have specified the word additional working capital, right? Additional working capital can be recovered in the last year of the project. Let me move this to the side. Okay. Expected useful life of the new equipment is 5 years. If the new equipment is purchased, the annual increase in the profit after tax of the company is 210,000. So if you buy this new equipment, your profits will go up by 210,000, right? Okay. The required rate of return of this project is 10%. That means the discounting factor, and it's discounting factor to the nearest 2 decimals. So that's fine. What do they want from us? First one, schedule of cash inflows and outflows for the project for each year. So they want a schedule for cash inflows and outflows, right? So just like what we did earlier in the Excel, I will create a schedule here. Right. Sorry, I'm just getting a missed call. So basically create a schedule and use it here, right? So, because they want a list of cash inflows and outflows. I'm using a similar format from a previous question, right? Let me delete the information in this question, right? So let's see what is the information given and we'll include it here, right? So I'm going to switch screens. So first one, the old equipment can be sold at its book value of 250,000. So we will first include that because that is a cash inflow. So you can say sale of old machine. How much is that? 250. Purchase price of the equipment 1,800. So cash outflow, purchase price. How much? 1,800. Right. Just going to add a few rows here and keep. Next one, transport cost 200. So that is again a cash outflow. Transport cost 200. All of these are outflows in year 0 itself. Installation cost 75. Installation cost 75. Residual value of the equipment at the end of the useful life 125. So that is a cash inflow. You can sell the I will say scrap value, that means of the existing machine you can sell it for how much? 125. So at the end of the life, right, after 5 years. Additional working capital requirement at the beginning of the project 275. So I can say working capital required 275. I'll put it under year 0, right? And we can also, it says it can be recovered at the last year of the project. So I will say working capital recovered. Again, in the final year, I'm going to say 275. Yeah, I hope that's clear. If you all don't understand any entry I'm putting, please let me know. The expected useful life of the new equipment is 5 years, fine. If the new equipment is purchased, the annual increase in the profit after tax of the company is estimated at rupees 200,000. So you will increase your profits, right? So now, like I said, when we do NPV or investment appraisal, unless for other than ARR where we use profits, we don't use profits anywhere else. We use cash flows, right? So I can say cash flow savings or something like that, cash flow or incremental cash flow. I will say cash flow. And do I include this 210,000? The answer is no. Why? Because these are profits. I need the cash flow which you will be earning. So you're going to earn a profit of 210, but what will be the cash flow you're earning? So that you need to calculate. How? Similar to how we did the earlier question. Where is that? I think in 2013 we did that again. The net cash flow to profits. So we have profits. In this question, they are saying our profit is 210. Right? So let me just take this similar format into that place. They are saying our profit after tax is 210, right? So I need the cash, which means how do you go from profit to cash? I need to add the depreciation. How much is my depreciation in this question? Now that is the tricky part where students go wrong, and that is why I chose this question, because it's very hard to calculate. It's not very hard in the sense students get confused with so much of information on calculating the depreciation, right? So how do we calculate? How do we calculate depreciation? The formula cost minus scrap value. So you guys also can please give it a try. Before I do, then you can see, compare if your answer is correct, right? So cost minus scrap value divided by lifetime. What is my cost in this question? What is the cost of the machine? I have purchased 1,800. That is my cost. Transport 200. That is a cost that is included in my cost. Instead, I will have to include it. Installation cost 75. Yes, that is also part of my cost of the machine. Working capital required? Not really. That is not a cost for the machine. Sale of old machine? No, I don't include that as well. Why? Because that is just a cash flow which is going out in year 0. But it is not part of the cost of the machine, right? So sometimes students, where they go wrong is they deduct this, right? So that is where you go wrong, right? So getting 1 or 2 answers is interesting. It's good. Yeah, you guys, those who are calculated, just give some answers. It's interesting to see, right? So what is our cost? Like I said, my purchase price 1,800, the transport 200, installation how much is that? 75. Those are my costs. So this is my total cost of the machine, which is 2,075, right? So yeah, so I think for one person who gave the answer, that's correct, right? So my cost is 2075. So 2075 minus my scrap value. How much is scrap value? I can sell the machine for 125. It's not the scrap value you're selling the old machine for, it's the scrap value of the machine you're buying, which is 125. So small things, it might seem easy when you're probably practicing with me, but in the exam, things to be careful of because you might go wrong, right? And you divide it by the lifetime of 5 years. What is the answer you get? 2075 minus 125, you get 1950, and then you divide it by 5, you get answer is 390. Yeah, 390 is the depreciation. Yeah, so good. So some of you guys have got that. So then you include that. So now your profits are 210, right? So, okay, so I'll put it here first. My depreciation is 390, hence my cash will be, my cash flow will be, not cash, I'll say cash flow will be 600, right? So my cash flow savings are going to be 600 each year. Are we clear on this? So you can even take the totals of the both. Actually, you can just take total cash inflow. You can just take the total cash outflow. There is not much of cash outflow in the other years. And then you take the net cash flow, which is the cash inflow minus the cash outflow. Yeah, right? Yeah. So this is your answer for the first one. That is a question. Yeah, schedule of cash inflows and outflows of the project, right? This is a question. 1 second. Should we add the depreciation with the profit? Yeah, I mean, it's good if you can put it together because you're putting it as one line item, right? Because profits is not a cash inflow, right? And depreciation, we don't put it separately, right? Even in the fixed cost, when we removed depreciation from fixed cost earlier in the question as well, I can't remember which question was it. Yeah. The first question, 2011, when we removed the fixed cost was 800,000, we removed depreciation 300, and we directly put the 500. So I would recommend putting it together because depreciation is not considered a line item because they are told to put the cash inflows and outflows. So if you put depreciation, it's not a cash inflow or outflow. So it doesn't come here, right? So you can do the working separately, like how we did here, right? And then you can include that total amount, right? Then you can include that 600 totally here. I hope that question got answered. And this is your net cash flow. Right. So let's go to the question again. So that's part one. I hope it's clear. So why I chose this is because it's a bit of a tricky way to get this because it might be simple to get the depreciation in the sense to calculate the cash flow, but sometimes students go wrong in calculating this depreciation. Right, this 2075. Some people take the 250. Some take this in the sense they deduct the 250. So because of that, why I chose this question mainly. So like I said, investment appraisal is not a very difficult lesson. Please practice enough questions so that you can perfect yourself in this area, so that you can easily answer. So let's say if you have to answer the question within 20 minutes, try to do it within 10 minutes. Because if you are familiar with it, you can do it quickly. Use that time for another question, right? So let's go to the next one, NPV of the project. So we have our net cash flows. So I'll do the NPV somewhere here. Put the years. Let me take the cash flows. Yeah, so just type it out, right? So here it's minus 2100. me a second, some Excel problem, but yeah. Okay, right. So these are the net cash flows. Then you have your discounting factor at, the question says how much, at 10%. So you will put 9.9183. So here it's 1, then it's 0.91, 7568, 7568, and 0.62. Then you have the present value and the NPV, right? You will multiply your cash flow by the discounting factor, and then copy that formula across. Right, so these are your present values. Here you will sum all your present values and you will get a positive NPV of 422. So this is your NPV, right? So yeah, I mean, this is pretty much investment appraisal. So if you have any questions in what we discussed for now, I mean, for now on these questions which we did, please ask me. Hope everyone's okay and clear, and hope you guys clarified any doubts you all had relating to investment appraisal for now. And I hope keep practice the balance questions, and maybe even if you'll have your school papers, just go and practice it so that now you all have some better knowledge, and it will help you in your exams, right? I think so if things are okay from my end, I think probably hand it over back to Rotract. Okay, there's one question. 1 second. Okay, yeah. You're welcome. Yeah, sitting back to Rotract. They are there. Yeah.
So that concludes today's session. Thank you so much, sir, for sparing your time and joining us and doing a comprehensive session. And thanks to all our participants for joining with us today. Hope to see you in another wonderful session. Until that, stay safe and a very good night to all of you.